I really liked your comment. It was well written and easy to follow. So, on your point about gauging the total interest that we pay, I agree 10,000%. I can let you know what we usually do when we work with folks. So, whenever we are working with someone who is interested in using a life insurance policy to pay off their mortgage, and they want to do that because it's going to put them in a better situation by saving interest and also having their money compound for them the whole time in the policy. Where I always like to start is by looking at just the mortgage. Specifically, what does your life look like if you just keep doing exactly what you have been doing? For example, if someone is taking out a new 30-year mortgage, what I want to look at is how much am I paying in interest to the bank every month? What does that come out to over the course of a full year? And then what does that come out to over the course of the full 30 years? If I'm 5 years in, what does it look like for the next 25 years? And what we'll do is calculate the total amount of interest that I'm going to pay to the bank. If I am making extra payments or I plan on doing that, we also want to look at that. I again can see what is the total amount of interest I'm going to pay to the bank. I want to make sure that that is 100% crystal clear, and we've got the numbers laid out. This way, you, myself, and anyone else that's involved can look at it and say, if we just keep paying off the mortgage, here's what we're going to pay to the bank. And then we'll compare that to using a life insurance policy to pay off the bank, which involves funding the policy, building the cash value, and then taking a loan and paying off the mortgage. What we'll look at specifically is, first, how much interest do I pay to the insurance company every year and over the total term as well. So I would borrow the needed amount out to pay the mortgage off in full. And then when I pay the policy loan off, I can see, just like the mortgage, here's the total amount of interest I've paid, call it over a 30-year period or however long it takes. But that will let us know which one cost less interest. And in almost all cases, the life insurance policy does save us quite a bit of interest if I'm doing it early on, where regardless of what the mortgage rate is with a mortgage, I'm paying the majority of my interest in the early years. So if I catch it early, or if I start the strategy early, I'll save a ton of interest. But the main reason why people are often interested in this strategy is because the money they pump into a policy is compounding the whole time they're using it to pay off the mortgage. So when it's all said and done, they've earned interest the whole time as well. Hope this helps. Thanks again.